Hi, this is Osama Rizvi, and welcome to another episode of Monday Macro Review. Last week we discussed the developing countries and what's happening in the developing part of the world. Today I want to focus upon what's happening in the US, what's going on with the US economy, what are the new indicators, if any, that shows or cements the case for a recession, and most importantly, what is happening with the job market. Because if the recessionary factors are piling up, which indeed they are, then how come we are having such a good jobs report? So jumping right in, first of all, let's speak about the volatility index and S&P 500. In this chart on the left, you can see the returns by S&P 500, and on the other, the volatility index, the fear gauge of the Wall Street, as it is called. Both are on the 6-month timeline, and you can see that as the VIX has hiked, the S&P has fallen. Of course, there might not be a direct correlation to this, but overall, this speaks to the fact that mostly, broadly speaking, many observers, many market insiders and traders, they are sort of now buying the idea that we are heading for a recession. This happened specifically after Powell, he sort of took a U-turn, not a U-turn, but he really sort of just said it out loud that we might need to increase the rates further. And that has led many people to believe that the interest rates will spike at 6%. Here at Primary Vision, Mark, I myself, in our insights, in my research articles on primaryvision.co, in our YouTube show, the Econ Show, the Monday Macro View Show, we have said this multiple times that we don't see interest rates peaking at 5%. Larry Summers, former US Treasury Secretary, he also was one of the people who very early called out this thing that we might see 6% interest rates, and naturally that might trigger recession. We'll talk about the unemployment as well. So this is a good starting point to frame the things now, how things are looking at as we move forward. This was corroborated by the put and call options and the safe haven demand index. Both are from CNN, so they have the fear and greed index. They have this is calculated using 7-8 different measures of the stock market behavior, and this shows what's happening with the collective psychology, and something that I tend to focus upon a lot, which is the sentiments. So you can see the put options have risen once again, shows extreme fear. The safe haven demand as well, difference between the stocks and bonds. So stocks are riskier than bonds, but the reward is also asymmetric. So bonds can outperform stocks over the shorter periods, and safe haven demand shows exactly this, that the difference between treasury bond and stock returns over past, this is what I think, 20 trading days. And bonds tend to do better when there is fear in the markets, and as you can see, this is happening. In the next slide, you can see a little bit of the data I put it. So I put it together. The Treasury yields continue to be inverted, and it is deepening that inversion, and it has deepened all the way to 5.06%, the highest since 2017. The 10-year yield has also deepened, highest since 1980s, 108 basis point, or minus 1.08%. And stocks tend to be suffering from what analysts are calling the earnings recession. So we need to realize that something is happening, and in the near future, we will be seeing we might be seeing a sell-off in the markets. Coming to the jobs report, which was very interesting. So the U.S. economy, the U.S. job report continues to give resilient results. Last month, we added about 311,000 jobs, which was a little bit less than what was estimated, but not, on the lower side. It shows quite a lot of strength. However, the unemployment rate jumped a little bit, 0.2%. But that's not all. That's not all. Why? Because you need to read into the numbers and facts. When we look at the jobs report from that angle, from a different perspective, we see that the job cuts from January to February have hit their highest since 2009. In February alone, lays off in the United States stood at 77,770, which was 5 times higher than 15,245 job cuts announced a year earlier. So this came out from a recent report by Challenger Gray and Christmas and Company. And U.S. firms also announced to hire about 29,000 roughly workers in Feb, which was 87% down from 215,000 workers last year. So what's going on? The job reports are good, showing good results, but what's happening here? Consistent with this fact is a job leaver rate, which has slowed down a little bit, and the job loser share, which has continued to creep up. That is really important to know. So from 44%, it is now at 46%. However, amongst all this, the hourly compensation rate in real basis has decreased 2.8% in 2022. And this is the lowest since 1948, the lowest in the past 60 years, the wage growth inflation. What do we expect from this? Of course, we can expect wage price spiral or wage increasing pressures and therefore inflation expectations going higher and inflation remaining sticky. This is what I was just talking about. Wage growth is still not keeping up with the inflation. This is a year-on-year, month-on-month comparison. You can see average hourly earnings are here in the green, and the consumer price index, the inflation is there. So this gap between this big gap is the problem. And I believe this does not show up in the job report. Furthermore, if you look at the number of jobs that were added, so leisure and hospitality were the top one, was a top one, education and retail. But I also had a thought that what is the contribution of each of these? So it is actually the inverse. So the sectors like manufacturing, construction, business services, government, retail, those that has the highest share in the GDP, they didn't perform well. In fact, manufacturing did perform well at all. However, the others that have, this on the lower end of the spectrum, like leisure, like entertainment, like education, they added a lot of jobs, which sort of balances out. And also there is a lag in terms of economic indicators. So we might be seeing the effect of the rising monetary policy after a few months. Finally, money supply is also down. Money supply M2, we continue to follow M2 growth because that is one of the best indicators of the US recession. You can see in this chart as well, we can see whenever the money supply has hit this level, depression or a recession has followed. And I believe now the case is getting stronger for one. Just before we hop on the sentiment tracker, real food prices still remain quite elevated, presenting challenges for a lot of countries in the world. Finally, the market sentiment tracker. So you can see that there is good news. There is good news. Job report, the inflation in the Eurozone economy might be averting a recession. Growing Germany is improving a little bit. However, the factory orders in the US have fallen. German inflation has accelerated. Manufacturing in Germany is still weak, by the way. The latest SVB saga. Oil prices have fallen after recessionary risks have come to the surface. And Fed, of course, as I told in the starting, might revert back to a 50 basis point hike. VIX is at 4 years high increase, and yield curves continue to move deeper. So the overall outlook remains that recessionary pressures are building up. So that's all from myself today. I'll see you next week. But all of this just shows that we need to be very optimistic. We need to be cautiously optimistic. Thank you so much.